Being a small business owner, entrepreneur, or freelancer is cool. Not only do you own your time, but you also love what you do. And you can also take advantage of significant deductions come tax time. Hey everyone, I'm Josh Albayero, and today I want to tell you about the top 5 changes affecting small businesses. Before we get started, make sure you subscribe to this channel. And if you are on YouTube, click the alert notification to get notified when we go live. If you're a freelancer, sole proprietorship, Uber driver, contractor, subcontractor, receive a 1099 miscellaneous, you get the idea. You are considered self-employed. If you are, leave your comments or questions below and I will personally answer them. You're probably saying, Josh, it's only August. Why are you bothering us with all of this tax crap so early? When you are calling me to ask why your tax bill is so high, don't say I didn't try to help. Let's get into the top 5 tax changes affecting small businesses. Number 5, excess business losses. There's a long, super complicated explanation on the IRS website if you want to read it, but it boils down to your business losses not exceeding your income for a particular year. As always, your filing status defines the limitations. If you are single, the law limits your losses to $250,000 and $500,000 if you are married filing jointly. If you are single and have losses of $300,000 from all of your businesses, you could take up to $250,000 in losses and carry the remainder $50,000 over to the next year. Number 4, net operating losses. Again, there is another rocket scientist-like explanation on the IRS website if you're into solving riddles. But it comes down to this. You cannot use your current year losses to offset prior year taxes. Yes, this used to be a thing. You could carry your losses backwards 2 years and carry forward up to 20 years. Donald Trump used the carried forward method and avoided paying taxes for a long time. His companies had losses of almost $1 billion in the 90s, and his tax professionals legally spread the losses over the next 20 years. You could do the same if you didn't leave taxes until the last minute. We all have losses at some point. Why not take advantage of the law? B, your current operating loss is limited to 80%, meaning that if your business has a loss of $10,000, you can only claim $8,000 or 80% in losses. Number 3, qualified business income deduction. The QBI deduction allows most business owners to take an extra 20% of the qualified business net income, aka profit. Here's a good example. Sam is a sole proprietor with qualified business income of $120,000 for year 2019. Under Section 199A, Sam is entitled to a deduction of 20% of his QBI, or $24,000. As with anything related to tax, there are thresholds, limitations, and qualifications to take the QBI. Number 2, 100% first year bonus depreciation. The 100% instant write-off is allowed for both new and used qualified assets, which includes most categories of tangible, depreciable assets other than real estate. This change is a major tax-saving benefit on many business tax returns, including returns for sole proprietors and owners of pass-through entities. Number 1, reduce or eliminate deductions for business entertainment. Believe it or not, there is an explanation from the IRS that does not require translation. So here it is. The new law eliminates the deduction for any expenses related to activities generally considered entertainment, amusement, or recreation. However, under the new law, taxpayers can continue to deduct 50% of the cost of business meals if the taxpayer or an employee of the taxpayer is present and the food or beverages are not considered lavish or extravagant. The meals may be provided to a current or potential business customer, client, consultant, or similar business contact. So basically, don't make stuff up. If you need help with your taxes, books, or want to create a plan to save on taxes, check out my company, Iugo. If you enjoyed this video, leave a comment below, follow us, tell other people about it, and like it. Thank you very much.